Hi everyone, welcome back to Dr. At All. Are you riding the market waves or getting wiped out? Today, we are diving deep into the scalping strategy to help you master the art of precise entries and exits, maximizing your trading gains. When it comes to scalping, choosing the right time frame is crucial, and we will be focusing on the 1 minute, 3 minutes, and 5 minutes time frames. Why these specific intervals? Because in the world of scalping, the market's reaction is incredibly volatile and fast paced. You literally have seconds to think and act. Let's explore how to capitalize on these small windows of opportunity and turn rapid market movements into profits. Scalping is all about speed and precision, as the
Subscribe.
market can incredibly volatile in just a few seconds. The key here is objectivity. We need to execute our trades at the exact right price levels, not just where we hope to. Before we even think about profits and losses, our first job is to ensure we can make the moves we planned. Therefore, our primary tool are precision entry and exit points. We aim for quick, small returns, which means we need to capture those tiny but crucial market movements. This brings us to selecting the right indicator for quick signals. I recommend starting with an oscillator. I prefer the less commonly used William percentage R oscillator. So go to indicator and type William percentage R and select it. Now go to the settings and we need to adjust its settings. So adjusting its parameters to 140 instead of the standard 14, and also change the upper band to -5 and lower band to -95. This reduces noise and maximizes the frequency of signals,
Subscribe.
increasing our chances of catching high probability reversals. The second tool that we are using is another oscillator, which is MACD, Moving Average Convergence Divergence Oscillator. So go to the indicator and type MACD and select it. MACD is a versatile and widely used trading tool that offers several key advantages. It is particularly effective in confirming the direction, momentum, and duration of trends, making it invaluable for traders looking to validate their market analysis. The MACD generates clear buy and sell signals through its bullish and bearish crossovers, simplifying decision making even for naive traders. Additionally, it can detect potential price reversals through divergence, where the price trajectory differs from the MACD line, alerting traders to significant shift in market dynamics. Now go to the settings and change the fast length to 21 and slow to 55, which are Fibonacci numbers. Fibonacci
Subscribe.
numbers are of great significance in trading. If you are interested in Fibonacci numbers and their significance in trading, then you can watch our video. Check the link in the I button. Let's delve into how this strategy works. So far, we have established a few key components: the 1 minute chart, the index, which is Ethereum, the indicators like MACD set at 21 and 51, and William percentage R adjusted to parameters of 140 instead of 14. To see this strategy in action, let's move forward. Suppose the William percentage R rises above a certain level, followed by a sell signal from the MACD. For instance, when the William percentage R crosses above its horizontal line, a sell signal might soon follow from the MACD oscillator, as observed with market level, leading to a substantial drop of some
Subscribe.
pips. Interestingly, even if your stop loss is triggered in this strategy, it remains minimum due to the smooth indicators, which have increased the success rate. Similarly, for buying signals, look for when the William percentage R dips below -95. If the MACD then provides a buy signal, it's time to act. However, timing is crucial, as seen when a buy signal at market close missed an opportunity, only for the market to dip again and offer another chance upon retesting the level near -95. Scalping isn't just about technical know-how, it also demands strong control over your behavior. Indicators we use are key in keeping our decisions objective, which is crucial when we are deciding when to enter and exit trades. It's easy to greed to take over, but we need to stay disciplined, especially when our indicators warn us of a potential market reversal. Exiting your positions quickly and without bias is important to trading success because it's much easier to lose money in the market than it is to make it back. Sticking closely to these guidelines improves our chances of making a profit. I hope you find this strategy useful. If you have any thoughts or feedbacks, please leave a comment below. Don't forget to like, subscribe, and share this video if you found it helpful. Your support means a lot to us. Thanks for watching.